Can a revocable trust own life insurance? Have you ever wondered if a revocable trust can actually own a life insurance policy? This is a great question that many people have when considering their estate planning options. Let's break it down in simple terms. Yes, a revocable trust can own a life insurance policy. In the realm of estate planning, a revocable living trust is often used to hold various assets, including life insurance. This allows the grantor, the person who creates the trust, to manage those assets during their lifetime and to facilitate distribution after their death. When a revocable trust owns a life insurance policy, the trust becomes the policy owner. This means the trust can control the policy. The trustee can change beneficiaries, pay premiums, or even surrender the policy if needed. This can be especially helpful if the grantor becomes incapacitated. The successor trustee can manage the policy without needing to go to court. However, there are some important factors to consider. First, let's talk about estate tax implications. Since a revocable trust is revocable, the grantor retains control over the trust assets. This includes the life insurance policy. Because of this control, the death benefit from the policy owned by the revocable trust is generally included in the grantor's taxable estate. For those worried about estate taxes, this can be a significant issue. Another benefit of holding a life insurance policy in a revocable trust is probate avoidance. If the trust is the beneficiary of the policy, the proceeds pass directly to the trust upon the insured's death. This means the funds can be distributed to beneficiaries without going through the probate process, allowing for quicker access to the money. Now, let's discuss creditor protection. Life insurance proceeds are usually exempt from creditors when paid directly to named beneficiaries. However, if a revocable trust owns the policy and the trust document requires payment of debts and expenses before distributions, the proceeds may be subject to claims by creditors. This could expose the proceeds to creditor claims. It's also important to note the difference between revocable trusts and irrevocable life insurance trusts. An irrevocable life insurance trust is specifically designed to own life insurance policies. Unlike a revocable trust, an irrevocable life insurance trust keeps the insurance proceeds out of the grantor's taxable estate. This can provide significant estate tax advantages. The irrevocable life insurance trust owns the policy, pays premiums, and upon death, the proceeds are managed for the beneficiaries without increasing the grantor's estate tax liability. In summary, while a revocable trust can own life insurance and offers benefits like management during incapacity and probate avoidance, it does not provide the same estate tax benefits or creditor protection that an irrevocable life insurance trust offers. The choice between a revocable trust owning life insurance versus using an irrevocable life insurance trust depends on individual estate size, tax planning goals, and asset protection needs. Consulting with an estate planning attorney can help tailor the approach to your specific circumstances.